15th January 2018. Carillion, one of the UK's largest construction and services companies, applied for compulsory liquidation. No administration, no rescue. Liquidation. Straight to the end. £7 billion in contracts. 43,000 employees worldwide. 450 government contracts. Hospitals, schools, the HS2 rail project, army barracks. Gone. On a morning. Carillion had been built through acquisitions. Spun out of tarmac in 1999, it grew quickly by buying competitors and winning public sector work. By the mid-2000s, it was a FTSE 250 darling. Revenue over £5 billion. A preferred supplier to the UK government. The accounts looked fine. Here's what the accounts were actually saying. Reported operating profit was healthy, consistently in the hundreds of millions. Operating cash flow, the actual cash the business was generating, was consistently, significantly lower. This gap is red flag 1 from our free guide, link in the description. When a company reports profits but can't convert them to cash, something is wrong with how revenue is being recognised. Carillion was booking profits on long-term construction contracts before the work was complete and before the client had paid. The profit was real on paper. The cash wasn't there. That pattern held for years. Nobody asked why. While the profit figures looked solid, net debt was climbing. Every year, from around £200 million in 2012 to nearly £900 million by 2017. But the real debt position was worse than that. Carillion had been using something called reverse factoring or supply chain finance. When suppliers sent invoices, Carillion didn't pay them directly. A bank paid them instead. Carillion then owed the bank, not the supplier. The clever part, that liability to the bank didn't appear as borrowing in the traditional sense. It sat in trade payables, not flagged as debt, not counted in the headline debt figures. The true debt position, including supply chain finance, was materially higher than the headline number. This is red flag 3, debt growing faster than equity, dressed up to look smaller than it was. And then there was the pension. Carillion had a defined benefit pension scheme. The deficit, the gap between what was promised to retired employees and what the fund actually held, was growing. By 2017, it stood at over £900 million. This is red flag 8. A pension deficit growing in good times is a warning that the company is prioritising other uses of cash over its obligations to employees. Those other uses, in Carillion's case, included paying £554 million in dividends to shareholders between 2012 and 2017. A company with nearly £900 million in pension obligations and over £800 million in net debt, paying out over £500 million to shareholders. The board received £6.8 million in pay in the final year alone. The end came quickly once it started. 3 profit warnings in 5 months in 2017, each one revealing the gap between what had been reported and what was actually there, each one sending the share price lower, each one met with assurances from management that the situation was under control. In September 2017, 3 months before the end, Carillion paid its final dividend. In January 2018, it applied for liquidation. The government, its biggest client, had to step in to keep hospitals running and schools open. The pension scheme went to the Pension Protection Fund. Pensioners faced cuts to what they'd been promised. The auditors, KPMG, had signed off the accounts for 19 years, were later fined for failures in the audit. 19 years. 4 red flags, all visible, all in the public accounts. Profit without cash. Red flag 1. Debt growing faster than equity. Red flag 3. Pension deficit ignored while dividends flowed. Red flag 8. Dividends paid from debt, not profit. Red flag 10. The guide is in the description. Free download. These patterns show up before every collapse, not after. The question is always the same. Was anyone looking? Carillion. £7 billion in contracts. 43,000 jobs. 19 years of clean audits. Anyway,